Ahead of the weekend, we had the rand settle into a range, tracking a firmer euro against the greenback. We had sat at around 672. We've seen some retreat on the euro this morning, though. So what's your outlook for the rand and what's set to, one would assume, be a quiet week?
Morning, Alishia. Yes, we certainly anticipate a quiet week on markets because we have a public holiday tomorrow, and then the UK appears to be on holiday on Thursday and Friday. And from a rand perspective, most offshore rand trade is done through London. So the fact that they're on holiday means that it should be a relatively quiet week for the rand. Having said that, there is quite a bit of local data out this week. There's PPI, money supply, trade data. So that could certainly provide some direction for the rand, but it will certainly be amidst very quiet markets. And so we think it'll probably just remain range bound and continue to tread water and move sideways around current levels.
We'll get into that local economic data in just a bit, but of course on a global scale we've got all eyes on the Fed wrapping up its FOMC meeting tomorrow. What exactly are you looking out for and expecting on that end?
Well, Alishia, I think at this point what everyone's looking for from the Fed is an indication of what will happen beyond June. That's when their asset repurchase program comes to an end, QE2. That's when it comes to an end. So they will be, markets will be largely looking for some direction from the Fed as to what will happen beyond that. It's not likely that the Fed will engage in another round of quantitative easing, but there have been some comments from Fed officials that have been interpreted as relatively hawkish. We've also seen the ECB increase interest rates. So I think really what everyone will be looking for is when monetary policy in the US will be normalized.
Of course, that's where the dollar's woes have been centered around the fiscal problems and low interest rates in the US until now. Also, there's a strong dichotomy in terms of corporate earnings and what's actually playing itself out on the ground and filtering through in the form of economic data. How are you reconciling the two, Nomvuyo?
Well, as you mentioned, there's quite a divergence there, Alishia, and it is quite interesting. I think what will be crucial this week is the fact that we have the release of Q1 GDP estimates for the US. What's been consensus estimates is quite a sharp deceleration. We had growth of about 3% quarter on quarter in the fourth quarter of 2010. Markets now looking for a sharp deceleration to about 1.8% on the quarter. So I think that will largely inform what happens as far as markets go this week out, but certainly is something to watch as far as the US growth outlook for this year.
Of course, we've got the markets going for the higher yielding, higher growth currencies by selling dollars. Also, the prospect of widening interest rate differentials between the Fed and the ECB is in focus, and that many say likely to keep the euro weakness that we've seen filter through this morning in check. What have you made of ECB Governor Jean-Claude Trichet's comments that we've got a strong dollar in the interest of the US?
Well, some very interesting comments coming out of there, particularly ahead of the FOMC meeting. As you mentioned, we saw the euro weaken on those comments, but certainly has come back now. I don't think that one should read too much into his comments. It certainly could be an attempt to perhaps talk down the euro, which is helping to boost export growth in that area. But we shouldn't read too much into Governor Trichet's comments at this point.
Let's take a look at some of the expectations out of Japan. BOJ out with its rates decision as well. Expectations there?
We would expect the Bank of Japan to maintain its current monetary policy stance. They've already slashed rates quite aggressively, continue to provide ample liquidity to their markets in the wake of that earthquake. So we're not expecting much change from the Bank of Japan. Probably will just maintain policy rates where they are.
Nomvuyo, let's bring it back to that local data that you highlighted earlier on. Of course, we're anticipating PPI numbers on Thursday. With the inching higher that we've seen of that CPI number, what are your expectations on this front?
Alishia, we'd be expecting to see an acceleration in PPI. It's overshot expectations for both January and February, so we'd expect that we'd expect a continued acceleration. Very strong evidence of pricing pressures coming through into the economy from the PPI. So we've penciled in a rate of about 7.2% year on year for March, and that would be up from about 6.7% in February.
Pricing pressures coming through, and we've been speaking to traders at the desk saying that it's hard not to see retailers, for example, starting to filter those costs onto the consumer. Filtering them through to the consumer, in what state of health though, Nomvuyo? We've got credit numbers coming out on Friday as well, and you're expecting an uptick on that front too.
Yes, Alishia. What we have at the moment is a situation where inflation is rising quite strongly, driven mainly by fuel and food prices. But although those are generally transitory effects, there is still the real threat of second-round effects being reflected in the economy. As you mentioned, retailers cannot hold out on increasing their prices forever. However, on the consumer side, certainly looks like consumers at this point are focusing on paying down debt. We've seen a very slow uptake of credit from households. And in addition, we've seen some moderations in retail sales numbers. So there certainly are those conflicting pressures happening in the economy. But looking forward, we definitely do see these increases in the PPI eventually being reflected in increases in CPI.